2 days ago, Donald Trump dropped a $5 billion bomb on Jamie Dimon and JPMorgan Chase, and I am willing to bet everything that this lawsuit is not about what they are telling you it is about. Because while every media outlet is focused on the debanking story, there's a much bigger game being played here, and it involves the single greatest wealth transfer in modern history happening right now in the silver market. Let me show you exactly what I mean. On January 22nd, 2026, President Trump filed a $5 billion lawsuit against JPMorgan Chase and its CEO Jamie Dimon in Miami-Dade County, Florida, accusing the bank of politically motivated debanking after January 6th, 2021. And here is where it gets interesting. The very same day Trump filed this lawsuit, silver hit an all-time high of $103.45 per ounce, and JPMorgan stock had already fallen 10% from its early January peak. Now, most people would say that is just a coincidence, but I have been tracking the silver market for years, and I can tell you with absolute certainty that there are no coincidences when it comes to JPMorgan and silver. Here is what nobody is talking about. JPMorgan Chase has been at the center of silver market manipulation for over a decade. They paid $920 million in fines in 2020 for rigging precious metals markets through a practice called spoofing, where traders place fake orders to manipulate prices and then cancel them before execution. That was the largest fine ever paid by a bank for market manipulation, and it barely made headlines. But here is the part that should make you sit up and pay attention. Between June and October of 2025, JPMorgan did something unprecedented in the history of the silver market. They sold off their entire 200 million ounce paper short position that they had maintained for years, the position that many analysts believe was used to suppress silver prices for decades. And they did not just close their shorts, they flipped completely long. Right now, JPMorgan holds over 750 million ounces of physical silver, the largest private stockpile in the history of the world that is equivalent to nearly an entire year of global mine production, sitting in their vaults, and in just 6 weeks alone, they added 21 million ounces to that hoard. Think about what that means. The same bank that spent years allegedly suppressing silver prices suddenly wants the price to explode. And now the President of the United States is suing them for $5 billion. Let me connect the dots for you, because this is where it gets really interesting. Trump has been publicly attacking JPMorgan for years. In August of 2025, he signed an executive order targeting what he called politicized debanking, and he specifically called out JPMorgan and Bank of America at the World Economic Forum last year, telling them to open their banks to conservatives. But here is what the mainstream media is not telling you about this lawsuit. The complaint filed in Florida accuses JPMorgan of terminating Trump's accounts without warning or provocation, causing what the lawsuit calls significant financial and reputational harm. And according to the filing, Trump claims he was forced to reach out to other financial institutions, making it clear that he had been debanked. Now, JPMorgan responded by saying they do not close accounts for political or religious reasons, but only because accounts create legal or regulatory risk for the company. But here is the million-dollar question, or should I say the $5 billion question. If this is really about debanking from 2021, why is Trump filing this lawsuit now in January of 2026, right? As silver is hitting all-time highs and JPMorgan is sitting on the largest physical silver position ever accumulated. I believe this lawsuit is about leverage, and I'm not talking about financial leverage. I'm talking about political leverage. Let me explain what is really happening in the silver market right now, because once you understand this, everything else starts to make sense. Silver just hit $103.45 per ounce on January 23rd, 2026. That is an all-time high, shattering the previous record and representing a gain of over 214% in just 12 months when silver started. 2025, it was trading around $31 per ounce. But the spot price is only part of the story. In Japan, in the United Arab Emirates, physical silver was trading at $130 per ounce, while the COMEX futures price showed just $72. That is an 80% premium for physical metal over the official paper price. And that has never happened before in modern markets. What does that tell you? It tells you that the paper silver market is breaking down. It tells you that the system that has been used to control silver prices for decades is coming apart at the seams. And it tells you that whoever controls physical silver right now is going to make an absolute fortune. And who controls the most physical silver in the world? JPMorgan Chase. Now, let me tell you about the short squeeze that is happening right now, because this makes the GameStop squeeze look like a warm-up exercise. Between early and mid-January of 2026, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery in just 7 days. That means roughly 26% of COMEX registered inventory disappeared in a single week. The paper-to-physical ratio in the silver market had reached 356 to 1, meaning for every 1 ounce of physical silver, there were 356 ounces worth of paper claims circulating in global markets. That system only works as long as nobody asks for delivery all at once, but in early 2026, that assumption failed. Traders are now rolling their contracts backward from March to January and February because they want to take physical delivery. Now, they do not want to wait. And if this continues, the COMEX could end up in serious trouble. Silver lease rates, which normally sit around 0.25 to 0.5%, spiked to 8%, and at one point in late 2025, they exploded to 200%. The Swiss refiner, Metalor, which operates in 17 countries, announced they would not return to the market before January 2026 because there simply was not enough metal available. And here is the kicker. On January 1st, 2026, China implemented new export restrictions on refined silver. Only 44 companies received authorization to export silver over the next 2 years, establishing government gatekeepers over approximately 121 million ounces of annual exports that represents 60 to 70% of refined silver traded globally. China is not just restricting supply. They are hoarding it for their own solar panel and electric vehicle production, while cutting off the West, and physical silver premiums in Shanghai are running $8 to $10 per ounce higher than Western prices. This is not a normal market anymore. This is a war for physical metal. Now let me tell you why. Bank of America just released the most shocking price target in silver history. On January 5th, 2026, Bank of America, head of metals research. Michael Widmer released a forecast that sent shockwaves through the investment world. He projected that silver prices could reach between $135 and $309 per ounce in 2026. Let me say that again, $309 per ounce. At the time, silver was trading around $90 per ounce, which was already a massive rally. Bank of America was saying it could more than triple from there. Why would one of the largest banks in the world make such a bold prediction? Because they see what I see, a perfect storm of 3 powerful forces converging at once. First, the supply problem. Silver has been in a supply deficit for 5 consecutive years. In 2025, global demand reached 1.24 billion ounces, but mine production only delivered 813 million ounces. That is a gap of over 400 million ounces that had to come from somewhere. Physical inventories in London, Shanghai, and major U.S. exchanges have been drawn down to multi-year lows. Silver is disappearing from vaults faster than it can be replaced, and once it is used in industrial production, it is removed from the supply forever. Second, the demand explosion. Silver is not just a precious metal anymore. It has become a critical industrial commodity. Solar panels, electric vehicles, AI data centers, and advanced electronics all require silver because it has the highest electrical conductivity of any metal. In 2025, the U.S. government added silver to the official list of critical minerals, putting it in the same category as rare earth elements essential to national security. Solar panel production alone consumed approximately 230 million ounces of silver in 2025, up 25% from the previous year, and the new TOPCon cell technology requires 50% more silver than older models. Third, the monetary crisis. Central banks around the world have been buying gold and silver at record levels. Gold reserves now exceed their holdings of U.S. treasuries for the first time in modern history. The Federal Reserve is widely expected to keep rates unchanged at their next meeting. But here is the wild card. Trump has finished interviewing candidates to replace Jerome Powell as Fed chair, and he is expected to announce his pick very soon. The 4 finalists are Kevin Hassett from the White House economic team, Kevin Warsh, a former Fed governor, Christopher Waller, a current Fed governor, and Rick Reeder from BlackRock. Trump has made no secret that he wants lower interest rates. He told the Wall Street Journal he wants rates at 1% or maybe even lower, and a more dovish Fed chair would be extremely bullish for precious metals. Now, let me bring this all back to the JPMorgan lawsuit, because here is where it gets really interesting. Jamie Dimon recently warned that the $38 trillion national debt is not sustainable, calling it one of 2 tectonic plates that may crash in the near future. And yet his bank is sitting on 750 million ounces of physical silver, the ultimate hedge against monetary collapse. Is it possible that Trump and Dimon are actually on the same side here, despite the public lawsuit? Consider this. When JPMorgan debanked Trump in early 2021, silver was trading around $26 per ounce. If Trump had been allowed to deposit his funds and invest in silver through JPMorgan, he would have missed out on one of the greatest bull runs in history. But maybe Just maybe that debanking forced Trump to find other ways to position himself for what was coming. I'm not saying I know for certain what is happening behind closed doors, but I have learned over the years that when it comes to the silver market, nothing is ever what it seems. Now let me tell you what I think happens next. The CME, which operates the COMEX, just implemented a radical shift in risk management, transitioning from fixed dollar margin requirements to a percentage-based system with initial margins of 5.5% for gold and a staggering 9.9% for silver. This is exactly what they did in 1980 during the Hunt brothers squeeze when the COMEX implemented Silver Rule 7 to break the cornering attempt. But here's the difference this time. The Hunt brothers failed because they relied on paper contracts rather than physical metal. And when the government intervened, they were forced to sell. JPMorgan learned from that mistake. They are holding physical silver, not paper, and no government intervention can force them to sell physical metal. They own outright. The current squeeze is not driven by two wealthy Texans. It is driven by China, the solar industry, European central banks, and institutional investors who finally understand that silver is critically undervalued. If you adjust the 1980 high of $49.45 for inflation, silver should be trading at around $194 to $200 per ounce today, and Bank of America is saying it could go even higher to $309. At current prices, silver has already more than tripled in the past 12 months. But if these analysts are right, we could see another triple from here. Now, I want to address something very important. Some people are going to say that this is all speculation, that I am connecting dots that do not exist. But let me ask you this. Why did JPMorgan pay $920 million in fines for manipulating the silver market if they were not actually manipulating it? Why did they spend years maintaining a 200 million ounce short position and then suddenly flip to a 750 million ounce long position right before silver started its historic rally? Why is physical silver trading at 80% premiums over paper prices in some markets if there is no supply crisis? Why is China restricting silver exports at the exact moment Western inventories are being depleted? And why is the President of the United States suing the largest bank in America for $5 billion right as silver hits all-time highs? I do not believe in coincidences, not when there is this much money at stake. Here is what I think you need to understand. We are witnessing a fundamental restructuring of the global monetary system. The paper promises that have controlled commodity prices for decades are being tested against the hard limits of physical supply. And when paper promises exceed physical reality, something has to give. The silver market is the canary in the coal mine. When JPMorgan flipped from short to long, they were telling us something. They were telling us that the game has changed, that the suppression is over, and that physical metal is about to become more valuable than anyone imagined. Trump suing JPMorgan is just another move on the chessboard. Whether it is genuine animosity or political theater, the result is the same. It puts pressure on the bank and keeps the spotlight on the financial system. And while everyone is distracted by the lawsuit, silver continues its march toward triple digits and beyond. Now let me tell you exactly what Bank of America sees that makes them so bullish. They point out that during Fed easing cycles, when inflation is above 2%, gold prices have historically risen by an average of 13%. And silver typically outperforms gold during these periods, sometimes by a factor of 2 or 3. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically ranged from 40 to 60, but it recently collapsed from nearly 100 to 1, down to around 50 to 1. That means silver has already dramatically outperformed gold, but Bank of America believes there is more room to run. Investment demand for silver remains relatively light compared to gold, even though gold ETF inflows have rebounded. Silver positioning remains below historical averages, which means when sentiment shifts, the magnifying effect of capital inflows into silver could be much more pronounced. In the first half of 2025, silver exchange traded products saw a record inflow of 95 million ounces, and that trend is accelerating. But here is what really matters. Unlike gold, which is primarily a monetary metal, silver has dual demand, both investment and industrial, and that industrial demand is not optional. You cannot build a solar panel without silver. You cannot build an electric vehicle without silver. You cannot build the AI data centers that are powering the technology revolution without silver. The US government recognized this when they designated silver as a critical mineral. The Chinese government recognized this when they restricted exports. The European central banks recognized this when they started accumulating physical metal. And JPMorgan recognized it when they built the largest silver stockpile in history. The question is, do you recognize it? Now, I want to talk about what this means for the average investor because I know that is what you really want to know. If Bank of America is right and silver reaches $135 to $309 per ounce from current prices around $100, that represents an additional 35 to 209% upside. But here is the catch. The paper silver market and the physical silver market are diverging. If you own paper silver through an ETF or futures contract, you may not get the same returns as someone holding physical metal. Remember those 80% premiums in Japan and the UAE. Those premiums exist because physical silver is scarce, and when physical supply cannot meet demand paper, claims become worth less than the metal they supposedly represent. This is why JPMorgan holds physical silver, not paper. This is why China is restricting physical exports. This is why central banks are accumulating physical metal. And this is why I believe every investor should seriously consider their exposure to precious metals. I am not a financial advisor, and this is not financial advice, but I can tell you what I see. I see a market that has been manipulated for decades, finally breaking free. I see supply deficits that cannot be filled because there are no major new silver mines coming online until 2027 or 2028. At the earliest, I see demand accelerating from solar, EVs, and AI, while supply remains flat or declining. I see the largest bank in America sitting on the largest silver hoard in history, and I see the President of the United States putting pressure on that bank, right? As silver hits record highs, whether the Trump JPMorgan lawsuit is real or theater, it does not matter. What matters is what it represents: a shift in the balance of power, a recognition that the old system is breaking down, and a signal that physical assets are about to become much more valuable. Now, let me tell you about one more piece of the puzzle that most people are completely missing. On December 26, 2025, the New York Federal Reserve delivered a $17 billion emergency cash injection to an undisclosed bank. And over the following days, additional injections brought the total to over $50 billion. Nobody knows for certain which bank received that money, but the timing is suspicious. It happened right as silver prices were spiking and margin calls were hitting traders with short positions. Some analysts have speculated that a major bullion bank was in serious trouble from silver short positions and needed emergency liquidity to avoid collapse. Whether that is true or not, I cannot say, but I can tell you that the Fed does not hand out $17 billion on a random Friday unless something serious is happening behind the scenes. And here is what I find most interesting. JPMorgan was prepared for this. They had already closed their short position and flipped long. They were not the ones needing a bailout. They were the ones positioned to profit from the chaos. That tells me that JPMorgan knew this squeeze was coming. They saw the writing on the wall and they positioned themselves accordingly. The question is, who was on the other side of that trade? Who was caught short and needed an emergency bailout from the Fed? We may never know the answer, but I can tell you this. Whoever it was, they are not in a good position, and the squeeze is far from over. Let me paint a picture of what the next 12 months could look like. If current trends continue, COMEX inventories will continue to decline as more traders stand for physical delivery. China will maintain or even tighten its export restrictions. As domestic demand grows, industrial consumption will increase as solar and EV production accelerates. Investment demand will grow as more investors recognize the supply deficit, and central banks will continue accumulating physical metal as a hedge against monetary instability. All of these forces point in the same direction: higher silver prices. Bank of America sees the high end at $309. UBS has raised their target to $60 with the possibility of testing $65. And if you adjust for inflation, the 1980 high would be around $200. But here is what most analysts are not accounting for. The current squeeze is different from anything we have seen before because it is happening across multiple markets. Simultaneously, London, New York, Shanghai, and Dubai are all experiencing supply tightness at the same time. There is nowhere left to shuffle the metal. In previous squeezes, metal could be moved from one market to another to relieve pressure. But now, every major market is tight, every vault is drawing down, every premium is elevated. This is not a temporary dislocation, this is a structural shift. And when structural shifts happen in commodity, markets' prices do not just rise, they explode. I have seen it happen with lithium, with rare earths, with cobalt. And now I believe we are seeing it happen with silver. The only question is, how high will it go? If you had asked me a year ago if silver could reach $100, I would have said probably not in my lifetime. And here we are at $103 and change. If you ask me today if silver can reach $200 or $300, I have to say I do not know, but I would not bet against it. The forces driving this market are too powerful to ignore. JPMorgan with their 750 million ounce position, China with their export restrictions, central banks with their accumulation industrial users, with their inelastic demand, and investors finally waking up to the opportunity. All of these forces are converging at once, and they all point in the same direction. Now, let me bring this back to where we started. Trump suing JPMorgan for $5 billion is not really about debanking. It is about leverage. It is about power. It is about who controls the narrative as the financial system undergoes its most significant transformation in decades. Whether Trump and Dimon are genuine adversaries or playing a more complex game, I cannot say. But I can tell you that this lawsuit puts a spotlight on JPMorgan at exactly the moment their silver position is about to pay off spectacularly. And that cannot be a coincidence. The silver market is telling us something important. It is telling us that paper promises are losing their value. It is telling us that physical assets matter. It is telling us that the monetary system we have relied on for decades is approaching a breaking point. Those who position themselves correctly will preserve and grow their wealth. Those who ignore the signals will be left behind. I have been following this market for years, and I have never seen a setup like this. The supply deficit, the demand surge, the short squeeze, the currency debasement, the geopolitical tensions, everything is aligning at once. This is not investment advice, and I am not telling you what to do with your money, but I am telling you what I see, and what I see is extraordinary. Silver at $103.45 is just the beginning. If Bank of America is right, we could see $135 to $309 before this is over. And when JPMorgan finally decides to sell their 750 million ounce position, that alone could generate profits that make the $5 billion Trump lawsuit look like pocket change. Jamie Dimon is not losing sleep over this lawsuit. He is too busy counting his silver. The real question is, will you be counting yours? That is all I have for today. Thank you for watching. Make sure to subscribe and hit that notification bell so you do not miss my next video where I will be breaking down the specific miners and ETFs that are best positioned to benefit from this historic silver rally. Until then, stay informed, stay prepared, and remember, in a world of paper promises, physical metal is king. I will see you in the next one. But wait, before you go, I need to tell you something else that happened this week that nobody is talking about. Trump just finished interviewing candidates to replace Jerome Powell as Fed chair, and he said he already has someone in mind. He told reporters, "I will be telling you soon I have somebody that I think will be very good, but I'm not going to reveal it yet." At the World Economic Forum in Davos, he narrowed it down, saying we are down to 3. But we are down to 2, and I probably can tell you we are down to maybe 1. In my mind, Treasury Secretary Scott Bessent has been leading the interview process, and he confirmed the 4 finalists: Kevin Hassett, who runs the National Economic Council, Kevin Warsh, a former Fed governor, Christopher Waller, a current Fed governor, and Rick Reeder, who is BlackRock head of fixed income. Now here is why this matters. For silver, Trump has made it absolutely clear that he wants lower interest rates. He told the Wall Street Journal he wants rates at 1% or maybe even lower because it would reduce the cost of servicing the national debt, which now stands at $38 trillion. A more dovish Fed chair would almost certainly cut rates more aggressively. And when rates go down, precious metals go up. That is just basic economics. Historical data shows that during Fed easing cycles, when inflation is above 2%, gold prices have risen by an average of 13%, and silver typically outperforms gold by a factor of 2 or 3 during these periods. So if Trump installs a loyalist Fed chair who pursues steep rate cuts, we could see an even bigger rally in precious metals on top of what we're already experiencing. And here is the thing that really concerns me about the broader market. Jamie Dimon just warned that the $38 trillion national debt is not sustainable. He called it one of 2 tectonic plates that may crash in the near future, and this is coming from the CEO of the largest bank in America. The first tectonic plate is the debt crisis, the second is geopolitical instability, and we are seeing both of those forces accelerate right now. Trump just secured what he called total access to Greenland through a framework agreement with NATO, claiming there is no time limit on the deal. This gives the U.S. access to critical minerals, including rare earth elements that are essential for technology and defense. Greenland has mineral reserves estimated between $700 billion and $4.4 trillion, including deposits that could make it the second largest rare earth producer in the world. And here's the connection to silver. Greenland also has significant deposits of other critical minerals that compete with silver for industrial applications. But more importantly, the geopolitical maneuvering around Greenland shows how desperate the U.S. is becoming to secure critical mineral supplies. If the U.S. is willing to pressure NATO allies and potentially spend over $700 billion to access Greenland minerals, what does that tell you about the value of the critical minerals they already have access to, like silver? It tells me that the government understands something that most investors do not. Physical resources are becoming the most valuable assets on the planet. Let me give you some more numbers that will blow your mind. In 2024, the silver market deficit was 148.9 million ounces. And over the past 4 years, the cumulative deficit reached 678 million ounces. That is the equivalent of 10 months of mining supply in 2024 that had to come from somewhere. And where did it come from? It came from above ground stocks. It came from vaults in London and New York and Shanghai. And those vaults are now running dangerously low. COMEX registered inventories are down nearly 70%. Since 2020, London Bullion Market Association vaults have lost around 40% of their holdings, and Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. That is not a comfortable margin. That is a crisis waiting to happen. And the demand is not slowing down. Solar panel production is accelerating because of the global push for clean energy, and solar panels require approximately 20 grams of silver. Each multiply that by hundreds of millions of panels. And you start to understand why demand is overwhelming supply. Electric vehicles use 2 to 3 times more silver than traditional gasoline cars because of the electrical components. And as EV production scales up, silver demand will only increase. AI data centers require massive amounts of power, and many of them are being paired with solar arrays to meet their energy needs. A single 500 megawatt solar installation requires approximately 300 metric tons of silver. And none of this demand is optional. You cannot substitute another metal for silver in these applications because silver has the highest electrical and thermal conductivity of any element on the periodic table. There is literally no alternative. This is why Bank of America is so bullish. This is why JPMorgan accumulated 750 million ounces. This is why China is restricting exports. This is why the US designated silver as a critical mineral. Everyone who understands the fundamentals is positioning themselves on the same side, long physical silver. Now, let me address some of the skeptics, because I know there are people watching this who think I'm being too bullish. Some analysts point to the CME margin hikes and say this is just like 1980 when they broke the Hunt brothers squeeze. They raised margins to 9.9% for silver, and that triggered a wave of mechanical liquidation that sent prices lower. And yes, that did happen in the short term. Silver did pull back after the margin hikes. But here is the difference. In 1980, the Hunt brothers were using leverage and paper contracts when margins increased. They could not meet the margin calls and were forced to liquidate. Today, JPMorgan is holding physical metal, not paper. They do not have margin calls on physical silver in their vaults. The retail traders and speculators who were using leverage got flushed out by the margin hikes. But the underlying fundamentals have not changed. The supply deficit is still there. The industrial demand is still growing. China is still restricting exports, and institutional investors are still accumulating physical metal. Every dip created by margin hikes or profit taking is just another buying opportunity for those who understand what is really happening. Let me also address the Sprott Physical Silver Trust discount that some bears point to as evidence that there's no real shortage. PSLV is currently trading at a discount to its net asset value, which some say means there is no physical silver shortage. But that is a misunderstanding of how these trusts work. PSLV trades on the stock exchange, and its price is determined by supply and demand for shares, not by the underlying silver. The discount reflects investor sentiment toward the trust, not the availability of physical metal. Meanwhile, physical dealers are charging significant premiums over spot prices, and delivery times are extending. If there was no shortage, dealers would be selling at spot with immediate delivery. The paper market and the physical market are telling two different stories. And I am going to trust the physical market because that is where real transactions happen. Now let me tell you about something that happened in late December that most people missed. On December 26th, 2025, a single buyer reportedly placed an order representing nearly half of the world's annual silver production. Think about that for a second. Someone with extremely deep pockets decided they needed to secure that much physical silver right before the end of the year. We do not know who the buyer was, but the size of the order suggests it was either a sovereign wealth fund, a major central bank, or one of the largest financial institutions in the world. When buyers that large enter the market, it creates ripple effects that last for months or even years. Because once they accumulate their position, they are not going to sell, they are going to hold. And that takes supply off the market permanently. This is the dynamic that is driving the squeeze. It is not just about retail investors buying silver coins. It is about institutional money and sovereign wealth. Recognizing that silver is critically undervalued relative to its strategic importance, The Hunt brothers tried to corner the silver market with maybe 1/3 of the world's privately held silver, and they failed. But what if the new Hunt brothers are not two wealthy Texans, but rather China, the solar industry, European central banks, and JPMorgan all accumulating at the same time? That is not a corner, that is a collective recognition of value, and it cannot be stopped by margin hikes or regulatory intervention. Let me leave you with one final thought. The Trump JPMorgan lawsuit is $5 billion. That sounds like a lot of money, but JPMorgan generates that much profit. Every 90 days, their silver position alone could be worth over $75 billion at current prices. And if silver triples from here, as Bank of America suggests, it could be worth over $200 billion. $5 billion is nothing to them. But the lawsuit serves a purpose. It keeps JPMorgan in the headlines. It reminds everyone of their history of market manipulation, and it creates political pressure at exactly the moment the silver market is breaking free from decades of suppression. Whether that is intentional or not, I cannot say, but the effect is the same. We are witnessing the end of an era, the era of paper promises and price suppression, and the beginning of a new era where physical scarcity determines value. Silver at $103 is not the end. It is the beginning. Bank of America sees $135 to $309, the inflation-adjusted 19. 80 high is around $200, and some analysts believe we could go even higher if the squeeze accelerates. The forces driving this market are unprecedented, and they are not going away. I have been following silver for years, and I have never been more convinced that we are on the verge of something historic. The only question is, are you positioned for it? Thank you for watching. Make sure to like and subscribe, and I will see you in the next video where we go even deeper into what is happening behind the scenes. Stay safe and stack wisely.